Most people don't lose millions because of one big financial disaster. They lose it quietly through small mistakes made early in life. Delaying investing, chasing trends, ignoring taxes, and relying on emotion over strategy may seem harmless now, but over decades, these choices can erase massive amounts of future wealth. The real danger is that beginners rarely notice these mistakes until the opportunity to fix them has already passed. We break down the hidden financial missteps that silently cost you millions, and how to avoid them before they damage your long-term future. Today, we will talk about beginner mistakes that cost you millions in long-term. So, before we start, make sure to hit the like button and subscribe to my channel. 1. Waiting too long to start investing. The number one mistake that costs beginners millions is delaying investing. Compound interest is the most powerful force in wealth creation, and time is its fuel. Every year you delay can shrink your long-term portfolio dramatically. Even a small monthly investment started in your 20s can grow into a fortune by retirement. But that same investment started in your 30s or 40s may only reach a fraction of the amount. Many beginners think they need a lot of money to invest or believe they should wait until they're ready. But waiting is the most expensive decision. Starting small and starting early is worth more than trying to invest big later. 2. Keeping too much money in savings instead of investing. Savings accounts are safe, but they are not wealth builders. One of the biggest beginner mistakes is treating a savings account as the main long-term financial strategy. The problem is inflation. Your money slowly loses buying power every year. While savings accounts offer tiny interest rates, investments like index funds, ETFs, and retirement accounts grow significantly faster. Over decades, the gap becomes enormous. Money sitting idle in a bank may feel secure, but it guarantees long-term stagnation. The real danger is that beginners mistake safety for growth. And this mindset quietly costs them millions in missed returns. 3. Trying to time the market instead of staying consistent. Many beginners believe they should wait for the right moment to invest, often influenced by news cycles, social media, or fear of loss. This leads to analysis paralysis, endless waiting for a perfect entry point that never comes. Market timing feels smart, but statistically, it almost always fails. Missing just a handful of the market's best days can drastically reduce your lifetime returns. Wealth grows through consistency, not prediction. Dollar cost averaging, investing consistently regardless of market conditions, is the strategy that builds wealth steadily while protecting beginners from impulsive decisions. 4. Not understanding the power of fees. Most beginners don't realize how destructive fees can be. A 1% annual management fee might sound small, but over decades, it can wipe out hundreds of thousands, even millions, of potential earnings. Whether it's high-fee mutual funds, expensive advisors, or hidden platform fees, beginners often pay more than they should simply because they don't know better. Low-fee index funds and ETFs outperform most managed funds precisely because they eliminate these unnecessary costs. The difference between a 1% fee and a 0.05% fee compounded over 30 to 40 years is staggering, and beginners often learn this too late. 5. Failing to take advantage of tax-advantaged accounts. Ignoring tax-advantaged accounts like IRAs, 400 and Onyx, Roth accounts, HSAs, and pension plans is another mistake that costs beginners massive long-term wealth. These accounts reduce taxes today, reduce taxes later, or eliminate taxes entirely on investment growth. Beginner investors who stick with taxable investment accounts miss out on decades of tax-free or tax-deferred compounding. Additionally, many beginners don't realize that employer-matched retirement contributions are essentially free money. Ignoring or underfunding these accounts means giving up guaranteed returns and losing out on one of the biggest financial advantages available. 6. Relying on emotion instead of strategy. Emotional investing is one of the most destructive habits beginners fall into. Fear, excitement, panic, and greed influence decisions far more than logic. Beginners often buy high because of hype and sell low because of fear. They chase trends, follow the crowd, or panic during downturns. Emotional decisions feel urgent in the moment, but they lead to poor timing, unnecessary losses, and missed opportunities. Long-term wealth is built through discipline and consistency, not reacting to every emotional impulse or market headline. 7. Investing without understanding what you're doing. Many beginners jump into investments they barely understand: cryptocurrencies, NFTs, penny stocks, meme stocks, or risky trading strategies, because it feels exciting or because others appear to be getting rich quickly. Without understanding the fundamentals, beginners often expose themselves to unnecessary risk. They chase volatility instead of stability. They follow influencers instead of research, and they gamble instead of investing. Over the long term, this lack of education can cost more than money. It can cost confidence, opportunity, and years of progress. True investing requires knowledge, patience, and clarity, not blind participation. 8. Ignoring debt before trying to build wealth. Trying to invest while carrying high-interest debt is a hidden trap for beginners. When debt interest rates exceed investment returns, the growth of debt outpaces the growth of savings. Credit card debts with 15 to 30% interest destroy wealth faster than most investments can build it. Beginners who invest without tackling their debt first end up spinning their wheels, making progress on one side while losing ground on the other. Eliminating high-interest debt before or alongside investing is one of the most powerful moves for long-term financial freedom. 9. Not maintaining an emergency fund. A lack of emergency savings is another beginner mistake that derails long-term wealth building. Without a financial buffer, unexpected expenses, car repairs, medical bills, job loss, force beginners to withdraw from investments at the worst possible times. These premature withdrawals interrupt compounding, trigger taxes, and sometimes create losses during downturns. An emergency fund acts as a protective barrier, allowing investment accounts to grow undisturbed. Beginners who skip this step often lose years of progress with a single financial emergency. 10. Following trends instead of a long-term plan. Beginners often get caught up in trends, hot stocks, viral investing advice, once-in-a-lifetime opportunities, or get-rich-quick schemes. While trends come and go, wealth-building fundamentals never change. Consistent investing, diversification, low fees, disciplined behavior, and long-term strategy. Chasing trends almost always leads to buying overpriced assets or entering a bubble too late. A long-term plan, on the other hand, ensures stability and protects investors from hype, noise, and emotional decisions. 11. Underestimating the impact of inflation. Many beginners focus on earning and saving without understanding how inflation silently erodes wealth. Inflation decreases the value of money over time, making cash savings worth less with each passing year. Beginners who avoid investing because it feels risky often lose far more by letting inflation shrink their savings. Investing in inflation-resistant assets, like the stock market, real estate, or diversified funds, is essential for protecting long-term buying power. 12. Not automating finances early enough. Automation removes human error, forgetfulness, and emotional interference. When beginners fail to automate savings and investments, they rely on discipline alone, which often leads to inconsistency. Automated investing ensures money goes into savings, retirement, and investment accounts long before it can be spent. Beginners who don't automate lose precious time and momentum, reducing the lifetime impact of their contributions. If you like this video and would like to see more like it, please give it the thumbs up, leave a comment, and click the button to subscribe.